Federal Reserve.
The US Federal Reserve, the Bank of England, the European Central Bank, some of the most powerful institutions.
From being owned by the Rothschilds to being operated by lizard people.
Their arsenal allowing them to adjust interest rates, inflation, print money, and shore up the economy.
Fasten your seatbelts and enter the realm of real estate where hidden agendas, secret maneuvers, and a web of sinister forces collide. Join us as we peel back the layers of this intricate conspiracy, revealing the shocking truth behind the orchestrated chaos that has sent the real estate market into freefall. Prepare to have your mind blown as we expose the shenanigans of powerful figures pulling the strings behind closed doors, manipulating the market for their own nefarious gains. Uncover the dark secrets and untangle the intricate web of deception that has left countless homeowners and investors bewildered and betrayed. At this point, it's not conspiracy. It's plain dark humor on current conditions.
Who controls the British crown? Who keeps the metric system down? We do!
As we bounce into the spring home buying season, buyers and sellers find themselves in a comical standoff. The persistently high mortgage rates and home prices have left many prospective buyers scratching their heads while clutching their wallets. With fears of ongoing inflation, bank sector volatility, weakening economic growth, and an impending recession hanging in the air, the tension is palpable, with the government saying,
"Do I really look like a guy with a plan?"
Market mayhem. Adding to the spectacle, the Federal Reserve decided to raise its key interest rate by a measly 1/4 percentage point on May 3rd. They claim it's a precautionary move in case inflation decides to misbehave further. This rate hike indirectly impacts long-term home loans like those 30-year fixed-rate mortgages that keep homeowners awake at night. It's no surprise that these circumstances have sent the housing market into a bit of a tailspin. On one hand, the median existing home sales price experienced a slight decline of 0.9% to a still astronomical $375,700 in March compared to the previous year. This marks the second consecutive month of year-over-year price declines after a mind-boggling 131-month streak of record increases. But hold your laughter, because the show isn't over yet. Total existing home sales took a 2.4% nosedive from February to March and a whopping 22% plummet from the same time last year, according to the National Association of Realtors, or NAR. It seems like the buyers and sellers are doing a rather amusing dance, but the punchline remains elusive. The wave of uncertainty. Lawrence Yun, the chief economist at NAR, humorously remarked, "Home sales are trying to recover and are highly sensitive to changes in mortgage rates. Yet, at the same time, multiple offers on starter homes are quite common, implying more supply is needed to fully satisfy demand. It's a unique housing market. Indeed, a unique and baffling market that keeps us all on the edge of our seats. So folks, grab your popcorn and settle in." The freefall of the real estate market is proving to be a concerning issue, with statistics and punchlines that keep us simultaneously entertained and concerned. Hold on to your funny bones, folks, because the housing market recovery is looking a bit sluggish. After a delightful dance of declines in March and early April, mortgage rates decided to take a little hike, reaching a staggering 6.57% for the week ending May 25th. Oh, the drama.
Don't you want to marry me?
I'm going to marry Melanie.
But you can't, not if you care for me.
Oh, my dear, why must you make me say things that will hurt you?
If current economic conditions persist, with those sky-high mortgage rates and home prices soaring while the inventory remains as scarce as a unicorn sighting, we might be in for a long, slow climb with a few bumps along the way, says Danielle Hale, the chief economist at Realtor.com, in a statement that probably needed a drum roll. The mortgage fee bombshell. And speaking of bumps, we have a new contender in the ring. The Federal Housing Finance Agency, or FHFA, and its shiny new mortgage fee rules. Starting from May 1st, all you lovely folks who want a conventional mortgage but dare to place between 5% and 25% down will have the pleasure of paying more in fees. It's like getting a surprise bill after a carnival ride. Definitely not the kind of twist we were hoping for. Now, hold your laughter because the Biden-Harris administration claims these rule changes are meant to make home ownership more attainable and affordable for low and middle income borrowers. But wait, some housing experts aren't too thrilled about it. They argue that the higher fees will hit those considered less risky, like a slapstick comedy routine gone wrong. But wait, there's more. While we eagerly wait to see how the mortgage fee changes will impact home shoppers, let's take a moment to talk about mortgage application activity. Spoiler alert, it's not exactly breaking any records. Joel Kahn, the vice president and deputy chief economist at the Mortgage Bankers Association, reports that both conventional and government home purchase applications increased last week. However, brace yourselves because activity is still nearly 28% below last year's pace. Cue the sad trombone. But fear not, dear home buyers, for there is a glimmer of hope shining through the chaos. Some experts are predicting that a slow recovery may soon be underway. Sam Cotter, the chief economist with a touch of optimism, believes that with the rate of inflation slowing down, mortgage rates should gently decline over the course of 2023. It's like a plot twist in a rom-com. Unexpected, yet heartwarming. So, borrowers looking to purchase a home, rejoice. Lower mortgage rates might be in your future, bringing smiles and a sigh of relief. The great inventory drought. In this wild ride of possibilities and predictions, one thing is for certain. The worries of homebuyers are real. With those pesky mortgage rates and fees, it's no wonder they're feeling a little jittery. So buckle up, because the housing market recovery is serving up a mix of humor, concern, and a sprinkle of anticipation. Let's hope the punchline brings joy to all those seeking a new place to call home. Since the infamous housing crash of 2008, the housing inventory has been playing hard to get. It's like trying to find a needle in a haystack, but instead of a needle, it's a house you're looking for. And guess what? It still hasn't fully recovered. We're talking about an inventory drought of epic proportions. The supply of houses is holding steady at near historic lows. It's like a game of hide and seek, but the houses are the ultimate hide and seek champions. Good luck finding one. According to the experts, the inventory is approximately 46% below the historical average. That's like going to a party with 46% fewer snacks than you expected. Talk about disappointment. With such limited options, it's no wonder home prices are shooting through the roof. The competition is fierce and the price tags are eye-watering. But here's the kicker. Unsold inventory is just hanging around, chilling like a couch potato. It's unchanged from March, lingering with a 2.6-month supply. It's like a guest who refuses to leave your party, hogging all the snacks and drinks. Can we get some more houses, please? Now, brace yourselves for the next revelation. 85% of homeowners are sitting pretty with mortgage rates below 6%. Sounds like a good deal, right? Well, don't get too comfortable. Industry experts are giving us the side eye, expressing doubts about when the inventory situation will finally sort itself out. Their prediction? Don't hold your breath for 2023. Game of chance. Single-family construction starts are on the rise, indicating a potential wave of new homes entering the market. It's like a cavalry riding in to save the day, armed with hammers and blueprints. We might see some light at the end of this inventory tunnel. The Federal Reserve is stirring the pot with its rate hikes. The moves they make can have unintended consequences, impacting borrowing costs for developers and making life a tad more expensive for suppliers. It's a delicate dance between the Fed and the housing market, and we're all just spectators. Final call. Now, let's address the burning question, will the housing market crash this year? Well, experts say it's more likely to correct itself rather than crash. We might experience some localized turbulence in regions that saw sky-high price booms during the pandemic. It's like a roller coaster ride with ups and downs, but hopefully not a full-blown crash landing. But let's not get too complacent. The possibility of an economic downturn looms in the background, casting a shadow of concern. A severe recession or prolonged stagflation could pose a serious threat to the market. It's a reminder that we should always keep a watchful eye on the economic landscape.